So, very simple question. You moved from, you did a 50 basis point hike in July and October. Now you've shifted back to 25. What's the signal here? How much closer are you now to seeing the end to the series of interest rate hikes?
Given the lot of uncertainty, it will be very hard to judge where we're going to stop or when. But our board members believe probably we can go about 3.5 around, but that range, we have to really see several factors. First, the decision of the FOMC in December, and also how the oil price will change after this price ceiling debates goes on, and then how the China COVID will evolve. And domestically, we have to also see the progress of our unfortunate and unnecessary credit crunch in our short-term money market. So considering all these factors, we decide to maintain our flexibility and think about our next move probably in January, because we do not have a meeting on December.
So how important is what the Fed does? And with that question, the fact that the Fed has been signaling that we're looking at 50, and now the latest minutes from their last meeting showed that it's clearly a debate and looks more like they may just do this. How much easier was it for you? Was that a factor in deciding, well, we can go now from 50 back to 25?
You can see how much the exchange rate in Korea as well as other countries has stabilized after the simple indication that Fed will slow down the pace of the interest rate hike, right? So definitely that eased the pressure in our FX market, and it gives more room for us to have different options. So definitely a good sign.
Speaking of your board members, it's interesting that you yesterday at your press conference talked about what they're looking for. You've got you're at 3.25%. You've got 3 of your board members seeing the terminal rate just 1 hike away from 3.5. Maybe close to the end of the rate hikes then. One thinks that yesterday's hike, with that you've done enough. And then there's 2 who say, well, you need to be ready for maybe something that needs to go above 3.5%. I know you respect all these views, but which one would you say is closest to your own view?
I shall refrain from commenting on it, because I think as a chair of the board, I'd rather maintain my last option when their opinions are evenly divided. So at this moment, I think all 3 options are plausible options given the uncertainties we have.
Gotta try, gotta ask. So, in your view, then, what will determine what the terminal rate is?
I think, as I mentioned, at this moment, most of the shocks that Korea is experiencing now is from abroad. So I think most important decision is how fast or how long the Fed will increase interest rate, because it has an impact on our exchange rate. We are not mechanically following the U.S. interest rate, but we are very mindful of its impact on our exchange rate, and because we have to secure the external stability first. And then we look at how much the growth will slow down in U.S., Europe, and China. The Korea is very export dependent. So those kind of growth aspect is also important. So those will be the key concern first.
So if the Fed does pause, say this spring, does that mean that you can pause too?
Not necessary.
Okay.
Then I think probably Fed pause means that our exchange rate will stabilize more. That will reduce the pressure on our inflation rate. But we have to see our inflation, because so our first mandatory is price stability. So as long as inflation is well above 5%, we may need to continue. But if, as you say, Fed pause and exchange rate stabilize, oil price stabilize, all these things, then probably our inflation rate may go down. So then we may, have that option too. So.
Glad you mentioned inflation, because a sort of a key rule of thumb for many monetary policy, academics and policymakers is when you have a high inflation rate that you're having a tough time get down, you won't get it down until you get your key rate above your inflation rate. Right now, your key rate's 3.25. Your inflation rate's running at 5.7% year over year. So you still have a negative rate, and that is still considered stimulus.
Actually, you can think about that way too. But on the other hand, when you actually subtract inflation rate, maybe the investors are thinking about real interest rate as a current nominal rate minus long-term inflation expectation because the investment horizon is longer. So if you think about our 5-year, 3-year inflation is well anchored at 2%, you can think about at this moment our real interest rate using expected inflation is around 1.5 range, which I think is upper part of the neutral rate or even maybe in the beginning of the restrictive area. So depending on inflation, what rate what you're thinking and how fast it's going to go down.
Okay, so so it still looks like this is all pointing to rate hikes ending potentially in the first half of next year, depending on what all those things turn out. But for example, if household and corporate debt are still high and growing, will this mean that the key rate has to stay in restrictive territory in the upper range of neutral even after inflation starts coming back down?
I think you really pointed out that my key medium-term goal. I think that Korea's leverage ratio, especially household debt, is relatively high range. It's not a systemic risk, but unless we address that issue, there can be a future risk factors. So I really hope to bring them down. But I think that's a medium-term challenges rather than a short-term because, you cannot deleverage in a very short period of time. That will cause many negative side effects. So you're right in the sense that which terminal rate will go down considering all these other options. But I think our first job at this moment, given that inflation is well above 5%, so we have to first take care about that issue first.
Okay, so there could be a very long period where you keep you stop raising rates, but that's where they stay, maybe for what, months, a year?
Oh, that will be difficult, right? Because you have to. So there's 3 factors we have to consider. Even though price stability is the first option, first mandate, we have to think about what's going to impact on the real economy, and then also we have to think about the medium-term impact on our leverages. Yeah.
So if there is a second half pickup in GDP, which is basically what you and your team are forecasting, would this rule out any kind of pivot to actual rate cuts? If you see, again, you've got inflation, maybe it's coming down, but you've got the economy picking up again. So would that mean, well...
I think I have to probably discuss this issue with our board members. Maybe after second half of this year, according to our projection, in the first half of at least first quarter of this year, inflation will be close to 5% range. So we'll focus more on how to stabilizing it. And then the growth will be lowered because we are expecting that more severe recession, slowdown in Europe especially, and the US, and they won't turn around very soon. And our growth heavily depends on the price of the semiconductors. And also semiconductor price we hope to pick up from the second half of next year. And we also believe that China's zero COVID policy will be loosened probably after March and on. So the sign of economic recovery will probably come only after in the second half of next year. And that time on, we have to think about this trade-off that you mentioned.
And you know how investors are, traders, once you pause, at least in the U.S., when are they going to cut? Yeah. So it sounds like the scenario you're painting is, why would you be looking to start cutting rates when you've got an economy that's picking up?
Yes, I think, but my point is that it's premature to talk about cutting yet. I think that is why we decide to have more flexibility. So let me say that at least in the first half of next year, we will think about when to pause and then how we're going to handle this inflation. And then once we have seen strong sign that the inflation is under control, then we have to think about the next trade-off that you just mentioned.